The story begins in August of 2004, and it's to do with Google's IPO. So Google at the time had a large group of incredibly talented coders who've been giving blood, sweat and tears to the company, and they were just about to reach the moment when they all became incredibly rich. And clustered around the edges of Mountain View, brokers from Morgan Stanley, Merrill Lynch and so on, was kind of camping outside waiting for this moment when they would be able to provide wealth services to all the Google entrepreneurs who are now fantastically rich. And there was a guy quite senior at Google, his name was Jonathan Rosenberg, and he said to himself, I'm a bit worried about this. And he asked the brokers, just not telling you to go away, but just stay in a holding pattern. And he went to Larry and Sergey and Eric and said, look, what I think would be really interesting is if we bring in just a bit of an educational program for these people who are all suddenly going to become richer than their wildest dreams. And the founder said, yep, great idea. And so they advertised this educational program in finance to the Google employees, and they all turned up in large numbers to sit and listen to the first presenter, who was William Sharpe, or Bill Sharpe, Nobel Prize-winning economist. He had one really clean, simple message. Don't try and beat the market. Beating the market is genuinely hard. I've worked all my life to try and find evidence that one can consistently beat the market, and I haven't found any. Focus on your job, get on with building Google, and buy a low-cost index fund. All right, okay, is it? Interesting. Next up was Burton Malkiel, and he came in and he had one simple message. He said, don't try and beat the market. He said, you can prove, and we sort of redo this these days, you can prove that you would have a better chance of outperforming the market by just throwing darts at the financial pages than by investing with an active manager who charges you large fees. But he also said, don't believe anyone who tells you that they can. Don't get lost following gurus, people on CNBC or on the television saying, buy this, sell that. Don't believe them. Get on with building Google and buy a low-cost index fund. The third person to come in, and by now I think the Google employees were starting to get the joke, was a chap called John or Jack Bogle. He's kind of a patron saint of certain aspects of the industry. He founded a firm called Vanguard, and he was the very first person to build an index fund that other people could invest in. He based it on the S&P 500, and depending on which day you look, it's now one of the largest mutual funds in the world. And Jack, again, two messages. First message, don't try and beat the market. It's really difficult. There's very little evidence that one can beat the market. And you know what else? Is you're going to be, as soon as you've got some real money to play with, you're going to be hearing from people about the ways and solutions that they have for you that will beat the market. But the thing is, they are being compensated by things that you can't see. They're being paid to sell you certain things, structured products, high front-end, high front-load mutual funds. They make trading commissions by giving you stock ideas that you then act upon. At the end of the session, Google's IPO happens, all these brokers come in, and all of a sudden they're faced with all these rather difficult, challenging questions about, could we maybe have a low-cost index fund, or how much fees are you really making when you're selling me this product? Well, that was 2004. What's happened since? What's happened in the market? So we've seen a massive financial crisis, and then we've seen huge liquidity from central banks. And that did two things. The financial crisis, there was nowhere to hide. Didn't matter how good you were at picking stocks, all that matters was whether you owned stocks or not, whether you were just in gold or US treasuries. Subsequent to that, since 2009, the market has been flooded with liquidity. And what that has done is it has compressed returns. It has given everybody free money, free cheap money, and it means that you're not punished for failure as a company. Now, what that means in technical terms is low dispersion. What it means in practical terms is it doesn't really matter which stocks you buy, they tend to track the market. And whereas in 2004 you'd have seen data like only 40% of active managers beat their benchmark. We put out a report last week that looked at European funds invested in US markets, and over the last 10 years, 99% of active funds underperformed the S&P 500. It's 1% who managed to beat the market. That's not guaranteed to continue, but you have an extraordinary 10 years, and over that 10 years, people have made decisions based on performance, and you've seen a lot of money coming into index-based investments. Not necessarily the S&P 500, but the S&P 500 in particular has benefited. It now has, just to give you an idea of how systemic it is, it's close to $3 trillion directly invested in the S&P 500, just tracking that index. But there is an elephant in the room here, and the elephant in the room is the efficient market hypothesis. Plenty of you will have come across the idea that markets are or aren't efficient, and the academic research didn't stop with Bill Sharp. And actually, even as early as the 70s, academics were finding certain things which appeared to be rules-based ways to outperform the market. Things like value, buying cheap stocks. Things like momentum, buying stocks that keep going up. Things like low beta, buying less risky stocks, seems to work. And this caused a huge fuss in the academic community, probably exemplified by the 2012 Nobel Prize, which was awarded jointly to, among others, Robert Shiller, who said markets are irrational, and Eugene Farmer, who said they're not. Now, there is a debate whether this is, so these sort of things like value and momentum, they're called anomalies. And there's a debate as to whether they are caused by behavioral aspects of human behavior. We do stupid things, or whether they're rewards for some kind of risk that you're taking on. Very obvious in the case of cheap companies. The risk is that they stay cheap and they're not very quick to respond. They're not growth companies, they don't have PhDs. What I want to tell you about is that what's happened is that they've now been encoded into indices, and it's one of the fastest growing areas of our business. It goes on all sorts of horrible names, and generally people call it smart beta. I'm not a huge fan of that because it's not necessarily smart. But the fastest growing area in terms of people investing in things which are tied to indices within our business is indices that do far more than what the original S&P 500 does. They're using quantitative screens to build and implement certain strategies that exploit inefficiencies or manage risk. And what's interesting about this is it's all being made available at incredibly low cost. The ETF structure, which many of you will be familiar with, the idea of an exchange-traded fund, has made this something which is essentially becoming widely available at a very low cost. Okay. The last thing that I wanted to talk about is where I think we're heading. That's a kind of very short potted history of indexing. And the opportunity for the next generation is absolutely enormous, because you have a situation where the delivery format and the ability of indecisers, asset managers, advisors to collaborate and build genuinely customized products to individual investors is enormous. If you're familiar with the concept of a long tail, we are not that far away from the moment when I can decide what my objectives are in terms of my retirement income, or what kind of strategy or like, or what kind of quantitative, super complicated system that I built in my shed, and being able to go and build an index out of it with someone like us and buy a product from it, from a broker or something like that. So we've had the basic let's buy the market. We've had let's buy the other key themes. And I believe that the next big trend in our industry is going to be far more customized, far more bespoke, and it's all going to be available at low cost because of technology. So this was the idea that I wanted to leave you with, that the indexing business is something with very long classical history. The Dow Jones Industrial Average, I think, is 130 years of history. But the really interesting stuff has only just started.